Welcome back, team. Mercer here. Today's signal in the metals market deserves your full attention. 6 weeks. Silver posted 6 consecutive green weekly closes, and now it has gone quiet. Price is moving sideways. Volume has thinned. The financial headlines are calling it momentum fading. I want to show you a different read. Because 3 times in the last 20 years, silver has done exactly this. Rallied hard for multiple weeks, then gone sideways, then gone significantly higher than the original rally took it. And every single time, the pause looked like the end. The media framed it as weakness. Retail sentiment turned cautious, and the move that followed caught most people flat-footed. Today I am going to walk you through those 3 historical setups, show you the structural signals that distinguish the pauses that led to breakouts from the ones that did not, and explain exactly what to watch right now to know which one we are in. If this is your first time at the desk, subscribe. I publish every morning before the market moves, and drop where you are watching this from in the comments. I want to know how far the desk reaches. Before we get into today's numbers, let me show you how one mechanism actually works, because if you understand this, the data we are about to look at will mean something completely different to you. The concept is positioning rotation, and it is the reason why silver consolidations look like weakness from the outside while something very different is happening underneath. Think of it this way. Imagine a building being sold. The current tenant, a short-term renter, has been there for 6 months. They occupied the space, used it well, and now their lease is up. They are moving out. During the move-out period, the building looks empty. No activity. Quiet. Anybody walking past might assume the building is struggling. What they cannot see is that a long-term institutional buyer has already signed the lease. They are moving in slowly, quietly, room by room. The building is not struggling. It is changing hands. That is exactly what a silver consolidation phase looks like at the structural level. In any futures market, there are 2 broad categories of participants: speculative traders, hedge funds, algorithmic systems, momentum-following strategies, and structural participants, commercial producers, industrial users, streaming companies, and long-term institutional holders. Speculative money drives the rally phase. When inflation expectations shift, or Federal Reserve rate cut odds move, or a delivery squeeze narrative gains momentum, speculative money floods into silver futures contracts. Price moves fast. Volume is high. The chart looks alive, but speculative traders are not holders. They are renters. They ride the momentum and then they exit. When the easy price movements lows, when the obvious catalyst has been priced in, they start rotating out. Position sizes shrink. Open interest in the front month declines. And here is what most people watching the chart get wrong. When speculative money rotates out, the price does not necessarily crash. It just stops going up easily. Volume drops. The chart chops sideways. Because on the other side of that rotation are structural buyers, streaming companies locking in long-term supply agreements, industrial users building inventory before the next demand cycle, institutions constructing positions that are not designed for the next week, they are designed for the next 2 years. These buyers do not chase momentum. They exploit the absence of it. A consolidation phase, when speculative excess is washing out and structural accumulation is building, is the market changing hands from fast money to slow money. The speculative squeeze brings price to a new level. The structural accumulation holds it there. And when the next macro catalyst arrives, whether from Federal Reserve policy, dollar direction, or physical delivery pressure, the speculative community has to bid above the existing structural floor just to get back in. That is what a breakout looks like from the inside. Now let's look at the 3 documented instances where this sequence played out in silver. Here is where silver stands today. Over the past 6 weeks, silver moved from the mid-$70 range into the low to mid-80s. It was not a straight line. There were sharp intraday reversals and volatile sessions, but the weekly close sequence told a consistent story each Friday. Silver settled higher than the Friday before, 6 times running. That kind of streak has a name in the technical literature. It is called a sustained momentum phase, and it typically ends in one of 2 ways. Either speculative positioning becomes crowded, the catalyst fades, and price reverses, that is the distribution top, or speculative positioning clears, structural buyers step in quietly, and price consolidates before the next leg higher, that is the accumulation base. Right now, the Commitment of Traders data published by the CFTC shows managed money gross long positions declining from their recent peak levels. That is the speculative cleanup signal. At the same time, the paper-to-physical ratio on the futures exchange run by CME Group, calculated as open interest in ounces divided by registered inventory ounces, remains elevated. Physical inventory has not replenished meaningfully during the consolidation. That means the structural imbalance between paper claims and physical supply has not resolved. It has persisted quietly beneath the sideways price action. That combination, speculative longs declining, physical imbalance persisting, is the same reading the market showed in 3 prior setups before significant continuation moves. I want to be precise here. These are indicators, not guarantees. The same setup can resolve in either direction depending on the macro catalyst that arrives. Next, what the structural data tells you is not where price goes. It tells you whether the conditions that preceded past breakouts are present or absent. Right now, they are present. Let me show you why that matters by walking through the historical record. Force 1. The 2006 consolidation. In mid-2006, silver had just completed one of its sharpest multi-month rallies in years. Price moved from approximately $7 per ounce in 2005 to nearly $15 by May 2006. Then it stalled. For the second half of 2006, silver traded in a range roughly between $11 and $13. Media described it as a correction. The commodity bull story shifted to oil and agriculture. What ended that consolidation was not a silver-specific event. It was sustained dollar weakness driven by current account imbalance and foreign reserve diversification, a macro catalyst entirely external to the silver market. When it arrived, silver did not return to its prior high. It went past it. By 2008, silver was approaching $21. By 2011, $49. The 2006 consolidation lasted approximately 6 months. The move that followed lasted 5 years. Force 2, the 2010 setup. After silver collapsed in the 2008 financial crisis, dropping from $21 to under $9, it spent nearly 2 years rebuilding. By mid-2010, silver had recovered to the mid-$18 range and then went quiet for roughly 2 months. Retail sentiment was cautious. The 2008 crash was still psychologically present. Risk appetite was subdued. The catalyst that ended the 2010 consolidation was Federal Reserve policy, specifically the signal of a second round of quantitative easing announced in November 2010. The market repriced what sustained unconventional monetary policy meant for real yields and dollar purchasing power. Silver moved from approximately $23 at the QE2 signal to $49 by April 2011. That is more than a double in 5 months following a 2-month consolidation. Force 3, the 2020 pattern. Silver crashed to under $12 in March 2020 during the pandemic sell-off and then rallied to over $29 by August, one of the sharpest short-term moves in its history. Then it paused for 6 months. Price chopped between $22 and $28. The COVID recovery narrative shifted attention to equities. Silver stopped being the story. What ended that consolidation was the January 2021 retail squeeze attempt, combined with broader institutional recognition that COVID-era fiscal policy had permanently altered the inflation baseline. Silver reclaimed $29 within weeks. Here is what most people watching this market are not seeing right now. In each of these 3 cases, the macro catalyst that ended the consolidation was not a silver event. It was a Federal Reserve decision, a currency move, or a fiscal policy shift that arrived externally and repriced precious metals as a category. Silver did not move because of anything happening inside the silver market. It moved because the macro environment shifted and silver was structurally ready to respond because the accumulation had already been done during the quiet phase. If you are waiting for a silver-specific catalyst to signal the end of this consolidation, you are likely watching the wrong variable. If you are tracking this setup with me through the resolution window, comment OJ signal that tells me who at the desk is following this in real time. 3 scenarios, honest probability estimates. No certainty claims. Scenario 1, continuation. Probability, 40%. The structural signals currently in place: elevated paper-to-physical ratio, speculative positioning cleanup, sustained physical inventory pressure, resolve in the direction historical precedent suggests. A macro catalyst arrives from one of 3 external sources: a dovish shift in Federal Reserve rate path communication, a further decline in the US dollar index, or an escalation in physical delivery demand at the CME Group exchange ahead of the next contract expiration. In this scenario, silver breaks above the recent consolidation range and moves into new high territory. The speculative community, which has been rotating out during the pause, is forced to re-enter above the structural floor the accumulators have built. Volume returns. The move is faster than the original 6-week rally because the supply of motivated sellers is lower. Scenario to extended consolidation. Probability 35%. No decisive macro catalyst arrives in the near term. The Federal Reserve holds its current policy stance without clear forward guidance shifts. The dollar trades sideways. Physical delivery demand at the exchange normalizes rather than escalating. Silver continues chopping in the current range for an additional 4 to 8 weeks. This is not a bearish outcome, it is a delayed outcome. The structural accumulation continues. The paper-to-physical ratio either holds or continues expanding. When the catalyst eventually arrives, the setup is arguably stronger than it would have been if the move happened sooner. Scenario 3 reversal. Probability 25%. The consolidation resolves to the downside. The macro environment shifts in a direction that supports dollar strength and real yield expansion, most likely a Federal Reserve communication that pushes rate cut expectations further into the future than current market pricing. In this scenario, the speculative cleanup accelerates into net short territory. Physical inventory at the exchange replenishes as delivery demand eases. The paper-to-physical ratio contracts. Silver gives back a meaningful portion of the 6-week rally before finding structural support. This scenario does not invalidate the long-term structural thesis. It delays it and resets the accumulation window at a lower entry level. Here are the specific verifiable data points I am watching to determine which scenario is developing. CME Group Vault Reports, published daily at cmegroup.com. I am watching the registered silver inventory figure, specifically not eligible. Registered is what backs delivery contracts. If registered inventory continues declining or holds flat during this consolidation, the structural imbalance is persisting. If it replenishes by 5 million ounces or more over a 2-week window, the squeeze pressure is easing and scenario 3 probability rises. CFTC Commitment of Traders report, published every Friday at cftc.gov, covering data through the prior Tuesday. I am watching managed money gross longs, specifically not net position. Gross longs declining while gross shorts hold flat is the clean speculative rotation signal. If gross longs start rebuilding before a price breakout, that tells you the speculative community is re-entering early, which historically has preceded the final push higher. CME FedWatch Tool, available at cmegroup.com. The rate cut probability distribution for the next 2 Federal Reserve meetings is the forward-looking macro variable most directly connected to silver's consolidation resolution in 2010 and 2020. Any repricing toward earlier or deeper cuts is the external catalyst signal. Physical dealer premiums. When retail physical silver premiums, the spread between paper spot price and what you actually pay to take delivery of a 1-ounce coin or bar widen during a price consolidation, it signals physical demand is running above what the paper market reflects. This divergence has historically been a leading indicator of the next paper price move, not a lagging one. None of these signals individually triggers a conclusion. All of them pointing in the same direction does. Here is the closing thought I want to leave you with. Silver does not break out when everyone is excited about it. Look at the documented history. Every major continuation move in silver began during a period when retail sentiment was flat or negative, when momentum had visibly faded, and when the mainstream narrative was questioning whether the rally was over. The excitement comes after. After the accumulation, after the quiet, after the structural buyers have done their work without anyone watching. We are not predicting a breakout. We are identifying a pattern that has repeated 3 distinct times in the last 20 years, and the structural conditions that characterize the setup phase in each of those prior instances: speculative positioning cleanup, sustained physical imbalance, macro variables aligned in the same direction, are present or forming right now. This consolidation may be the signal, not the warning. Do your own due diligence, understand the risks on both sides. The data is public, the sources are in the description. Verify everything yourself before making any decision. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. Mercer out.